Good morning, everybody. Hi, Alan. Hi, Veronica. Crazy week this week. And so I wanted to go over the markets a little bit like we usually do on Friday. Alan's got all the charts up, so let's start with you, Alan, and then Veronica will talk about.
I think Chris, you're going to go into more specifics later on. So I wanted to start off with kind of just some very, I think, evergreen advice and evergreen things to note. This chart, it's basically the markets, how they reacted when the news of President Trump's coronavirus diagnosis happened. So as you can see, every equity market is down. The bond markets are up. Oil is down. Why I'm showing this is just to put what I'm going to say into context, that you have, when something serious happens to the American political system, and specifically the executive, which is the president, then markets tend to react wildly, and they have been reacting wildly as we speak. What I wanted to do was kind of show that this is what is happening now, but then take a step back and say, look, guys, it's never as bad as it seems. Things go on, things continue. No matter what really happens, the political institutions in the United States in particular, are pretty strong, and they will, they won't really be impacted. The market shouldn't be impacted. This is, an opportunity, if anything, to buy, because it doesn't make sense to have this kind of irrationality over a short period. What I wanted to go through then is, and I don't want to be political for sensitive reasons today, but I like this chart from Societe Generale, and it basically shows the four scenarios which we've talked about in a couple of the last few weeks. But basically, if you really analyze these, there isn't a great deal of difference. In other words, whatever happens on November the 3rd, you're going to have continuity. You don't really have, one swing from free market, let's say fair capitalism, to communism. It's always in between. There's degrees, but it's always in between. And as you can see, there's very little difference. I mean, in the grand scheme of things, minus 0.4 to plus 0.2. U.S. headline CPI is 0 all over the board. CPI is 0 all over the board, and fiscal policy much looser, status quo. Not a big difference. Infrastructure spending over 4 years, yes, and yes on 3 of the boxes, and monetization of public debt to continue, yes all over. So there's really not much difference. What does that tell us about the stock markets, and what does that tell us about where we should be investing from a macro point of view, from just a pure investing point of view? Because you get people that maybe panic, take their money out, put it under their bed, or just don't want to invest anymore, or worry about even starting to invest in these kind of times. And this was from, I think, Invesco, I believe, these slides, truths that are important for any Western European, Western democratic system and Western capitalist system, is that markets have performed well under both parties, and it would be the same if it was Germany or France or the UK or other, Japan. Other countries like that. To go forward with a slide just on that one, this is an amazing slide, which is showing that if you remain fully invested for the last 120 years, that's where your money would accrue to. If you only invested when Republicans were in office, then you'd be down here, and only invested when Democrats were in office, you'd be slightly better off. But in the grand scheme of things, they're immaterial compared to where you are up here. So I just wanted to kind of throw that in there. But if I go back to this slide, you can see investors, as we've just seen, investors are better off staying fully invested. They don't radically re-engineer the US economy. It's small tweaks. If it ain't broke, don't fix it. The historical narrative is not as you remember. So there's a lot. It's very divisive at the moment, or it seems to be. That's the perception in a way. And there's no huge difference, I think, between the parties. Okay, there are significant differences, but not in economic terms. Legislative accomplishments are infrequent. We look back at Obamacare, look back at Reaganomics. There's very few things that have really changed the course of American history in any huge way. Predictions tend to be wrong. There was a lot of people that said when Trump would get in, markets would tank. When Obama get in, markets would tank. They didn't do either of those. And monetary policy matters more. So whatever the Fed is doing, and we know this from, if people have been watching the FIT talks, then we'll know that monetary policy matters a lot more, and you've got interest rates and fiscal policy is much more important. And it's okay if you don't like the president. the market doesn't care. The market will still do its own thing. And I wanted to point out number 9, and I'm a political student, but I didn't know that, and I need to get the names right, Hamilton died from, was it Burr that was the vice president who shot him in a duel? It was like 1804, 1809. It's not like,
yeah, I saw.
It's not like 500 years ago. It's quite recent. I mean, that's just. I mean, if you
they didn't have debates back then.
No, they didn't have TV debates in those times. No, there wasn't Dan Rather in the middle going, "Wait a minute, guys." I mean, that's insane. I mean, and that's only 200 years ago. I think 200 years is a blink, and this the vice president was in a duel with guns. I mean, it's nuts. So I mean, I just want to basically take these themes that you should be always invested in the market. The market will do its own thing. This is my all-time favorite graph format. And you can see global markets have never been the best. They've never been the worst. They just continue to do what they're doing. But if you basically diversify your assets over a number of different areas and have all the boxes filled, you'll do just fine, no matter who the president is.
I just want to point out where we kind of are with a couple graphs. And one of these graphs is, I wanted to bring this up last time, but you've got a large number of individual investors thinking that they're feeling bearish about this market. It was even higher last week. And so this is a contrarian indicator we look at. It's the AAII Investors Sentiment Indicator. And when this becomes so bearish and the number of bulls is low, it's a good time to think, okay, this market's already sold off, or it's actually, there's a lot of fear out there in the market. And so this is kind of a bullish indicator for the market right now. Another thing we see is kind of a bullish indicator is the NYSE, which is the number of stocks going up versus those going down, and then the volume that's related to that is now turning positive. Will be turning positive this next week. So this is a positive indicator for the market. Put call ratios have turned down again, and this is a positive for the market. Basically, October is panning out already as the possible bullish month before we even get to the elections. Or today we're seeing a sell-off on the markets, right? We saw it. But if you look at gold and stuff, it's not spiking. You're not seeing a lot of fear in the markets. The NASDAQ sell-off is pretty big today, but it's been up all week, so it's not a big problem really. I would say we're here, and even if we do come back and test some of these lows, this will probably be it for any kind of retracement or fall before the election. So as Alan was saying, people will get more used to the fact that it doesn't really matter who's going to win this or how it's going to be won. But once there's certainty about how it's going to happen, the market will probably recover. So I'll just leave it at that. I wanted to bring up one thing about the sectors. In the last 5 days, we've seen what is really leading is consumer discretionary, which is generally a long-term bullish part of the market. But things like real estate has bounced back this week big time. The COVID isn't going away. The number of cases is up again this week to highs. There's going to be layoffs in the airlines because of that. There's a long-term effect on a lot of that stuff. The employment numbers this morning weren't great, but there's just general feeling that things are going to start opening and things are going to get better. And, you've seen some of these kind of more defensive maybe sectors of the economy, including, we've mentioned before, industrials, healthcare, but, financials rebounded big. Now that might just be all a bounce off these lows before we go retest them. But, these are things that have been beat up pretty hard, and they got a lot of attention this week. Yeah, that's what I've got this week, guys. Avron, you wanted to go ahead?
I like to talk about what's trendy and what's in the news and how the investors can profit from that. For example, Barron's, Economist, Investors Business Daily, they all writing about digital payment systems and that cash is history. And we all know the rise of digital payments has been a powerful trend for quite a some time, even before COVID, and we've been covering it quite a lot. I pulled up this research from 2019 that it's a still enormous market that continues to expand. It's a guaranteed industry, guaranteed market that gonna last long even after COVID, after vaccines gonna come out. So it creates great opportunities for investors in tech-focused payment companies. And I would like to bring another chart, shows how diverse is this market. It's not only the big names that we all know, but it's also payment processors, it's payment systems, and we know that consumer and business behavior is shifting, and perhaps permanently. Millennials, of course, haven't been using cash at all. They use Venmo, they use digital cards. Seniors during COVID that are stuck at home also going cashless because they have no choice. Now we're also seeing that even governments worldwide are shifting to cards for distributing to consumers and businesses. Retail stores and restaurants are developing online sales channels. And even outside US, like India is cashless society is accelerating. Sweden is probably the closest to becoming the world's first cashless country. And like one of the hottest startups in Silicon Valley these days is Stripe, is still a private company, but it's a payment technology company that valued 36 billion currently. And I would like to look at some digital payment stocks like PayPal and Square. We can pull some charts right now. And they have been some of the best performers in 2020. And of course, right now prices are elevated and they could pressure the stocks in the near term. But for long-term investors, there is still time to jump in, and growth estimates are rising, and analysts keep hiking their price targets. And PayPal is the clearest winner in the digital shift. The company added a record of 22 million accounts in the second quarter, and that's about 140% over the prior year. And Wall Street expects PayPal earnings and revenue to both rise this year and also next year. The stock is about 70% up in the past 12 months. And that's because PayPal continues also to develop new revenue streams. And one such area is Hyperwallet, which is PayPal's instant cash platform used by companies like Uber, Etsy, to pay independent contractors and vendors. And also, if we look at MasterCard and Visa, they are broader plays on the global economy, but their businesses probably haven't seen the boost from COVID because the revenue went down. But those slows downs are temporarily. But when we see the recovery in the global economy and the travel, then it should lift card transactions volumes, and they are currently greatly positioned. So also both Visa and MasterCard are also expanding into high growth areas such as peer-to-peer, business-to-business, business-to-consumer, and also cross-border transactions. And also let's look at the behind the scenes payment processors like Fidelity National Information. Just one second. Like Fees and Global Payments. And both those companies made major acquisitions last year. For example, Global Payments, the company recently partnered with Amazon Web Services to distribute and sell payment services on a cloud-based platform. And as we looked at the table before, that all this digital payment system in fintech and payment industry, you can not necessarily target specific companies, but of course you can buy ETFs like ARKF, FinX, iPay, TPay, and many others. So these are really good for long-term investors as well.
Interesting. Yeah, a lot of these charts have, let's look at Visa real quick. I was looking at PayPal.
Yeah.
Veronica, while Chris is doing that, you mentioned ARKF there.
Yeah.
Yeah.
What is ARKF? It's ARK Innovation. It's ARK. It's an
fintech.
It's a fintech.
Fintech one.
Yeah.
So just to give a background, I mean, we use ARK quite a lot. So ARK Innovation is the kind of the everything. But there's like fintech, there's biomedical, there's like renewable energy. All of these 3D printing ETFs are segregated, and that's the fintech one, ARKF.
Yes,
Amazing.
they include the companies like top holding companies, Square, Tencent, Apple, Zillow, Alibaba, PayPal, and yes, like Rakuten and Lending Tree.
I think we also looked at GPN. I think, Chris, that was an old friend of AVC that we've looked at in the past. Yeah,
a lot of these I would say, this looks like it needs to break out of this trend.
I was going to say that's maybe a good time to buy it.
And then these other ones like PayPal, some of these others could use a little bit more of a pull back here. Like
they're
to come back.
Priced highly, but still.
Yeah. I mean, you said it was up 70% in the last 6 months.
12 months. Yeah, the last 12
but
months.
that includes like from last year. If you look at from the bottom here,
it's like over 100%.
140%. Like that's where it was before the market crashed, right? So this is huge. Had great earnings. That blew it right through its all-time high. And
I think it's an early stage technology still. So my point is there's a lot of scope for other companies to come through with a much improved technology. And it's a fast evolving sector, I think.
Ron, I think that slide you brought up before was really interesting because it showed so many different companies.
Yeah.
And there's a back end to this.
Chinese,
that's really
Russian is in there, and European.
Regional specific stuff. There's back end that's really into it. So if you really want to play on fintech, you might as well think you got part of Microsoft, because I know they're involved. They're consulting the banks and doing all the back end wiring of making the payment systems faster. And I think you're going to see a lot of
acquires. There's cash platforms, processors. My gosh,
there's a lot to do. And owning an ETF on this might make a lot more sense because you're not having to pick a specific
which is where ARKF comes in.
Yeah, ARKF and some others, and maybe we can look at Nasdaq Dorsey Wright and see what are some of the better performing ETFs in this sector, and bring those up next time. Okay, guys, that was a lot. So thanks very much. We'll talk next week. Until then, have a good weekend. Okay.
Let's hope there's something to talk about next week.
Right.
Okay, have a good weekend, guys.
Take care.